So I think it's the beginning of the end, right? I mean, you have FTX hammering the market, but I think one of the important things to take away from FTX and the collapse is that if you look at the Terra Luna collapse that caused or that Bitcoin took a hit on, Bitcoin dropped 45%. The FTX collapse, which was much bigger in terms of an earthquake for the crypto sector, you only dropped 25%. So what this is a market that still probably has some flushing out to go, but it is getting close. There's no doubt about it that we're getting close to it. We're also getting closer to potential regulation, which I think will be a huge asset for Bitcoin and cryptocurrencies, at least the Bitcoin and cryptocurrencies that are strong out there, as I do think that that will be a avenue for big money to start to dabble in crypto again.
Gareth remains bullish on Bitcoin in the long term, but his charts show that the cryptocurrency could potentially go as low as $9,000 in the short term. Despite this, Gareth plans to dollar-cost average and continue buying more Bitcoin as the price decreases. He believes that an inevitable price run-up is on the horizon and wants to be well-positioned for it. In a recent interview, Gareth compared the recent events in the cryptocurrency industry, such as the collapse of FTX, to the financial mistakes that led to the 2008 financial crisis on Wall Street. He then went on to explain that, similar to stocks, Bitcoin may take 6 more months to reach its bottom following such an event. The Federal Reserve continues to raise interest rates to quell inflation, which reached a peak of 9.1% in 2022. Soloway said that in 2023, inflation will remain high. "I do think inflation will remain elevated," he said. "Elevated means 3 to 4% and maybe 5%. Inflation is going to stay north of 3% for at least 2 years. He explained that wage inflation is going to be sticky, and that since wages have been rising, businesses will raise prices to offset the cost of higher wages. However, he added that the rate of inflation would trend downwards. In general, 2023 looks dire according to Soloway, who is predicting high inflation, high interest rates, and a weak economy. "We will have inflation, and then the Fed is going to push us into a recession that they can't bail us out of," he said. In an interview with Kitco News, technical analyst and chart reader Gareth Soloway shared his prediction for the potential lows of Bitcoin soon. According to Soloway, it is possible that Bitcoin could fall to a price range of between $12,000 and $13,000, he said in now outdated news. Soloway has a track record of accurately predicting the movements of the cryptocurrency market and had previously mentioned the possibility of Bitcoin falling below $19,000. In addition, Soloway also mentioned a worst-case scenario in which Bitcoin could potentially drop as low as $3,500, citing chart analysis and the impact of interest rate decisions made by the U.S. Federal Reserve as contributing factors. As we get into the video, keep your ears sharp and hear what Soloway has to say about Bitcoin, the macroeconomic outlook and Fed hikes, and the fate of gold. Is heading to now. Also endeavor to hit the like button, subscribe, and make sure to drop your notifications below.
So I'm still looking at potentially 12 to 13,000 is a short-term target. I do believe it'll go lower than that and probably pierce 10,000 and could get as low as 9,000 before this is all over. So again, if you look at it, and there's a couple ways. You could look at it the half full, the glass is half full, which is the negative, which is, oh my goodness, it could still go down 30, 40% more. Or you could look at it half full, which is basically saying Bitcoin's dropped from 69,000 to 16 and change here. Worst case, it's got another 7,000 and change to go. And then we can start to think about really picking some up heavily and looking for some major upside.
What about in the next couple of days? Are the charts pointing to any momentum in either direction for the next couple of days? Like you said, it's kind of choppy sideways.
I'm a buyer of Bitcoin, but again, it's a swing trade for me, looking for a move up here in the short term. But just understand, everyone out there understand that I'm not looking, this isn't a long-term trade. It's looking for a pop in the near term, the next 2 to 3 days, weeks, whatever it may be. And then once we get up, if we get up to about 18.5, I'll pare it back, take some profits, and then potentially just stay on the sidelines until I think there's a better entry.
All right, let's talk about the Fed now. Minutes came out earlier this week, and they basically announced that they would keep policy rates restrictive until inflation is no longer unacceptably high, were the words of the Federal Reserve governors. Let's pair that with the other economic data that came out this week, which is the ADP report. Jobs numbers came out. Initial claims were lower than expected, and the jobs payroll numbers were higher than expected, meaning the economy from an employment standpoint seems to be doing better than consensus expectations. Ironically, when that data came out a couple of days ago, I believe it was 2 days ago, the markets actually tanked So
Right.
let's describe what happened this week with the stock markets in relation to the Fed, in relation to employment.
Yeah, so you're right. Private sector jobs numbers came out much, much better than expected. We know that the Federal Reserve released their minutes earlier this week and basically said don't expect any rate cuts in 2023. And the markets didn't like that. The markets, again, this is hawkish talk. This is hawkish economic data on jobs. The key today, and this is why the markets rallied back on the non-farm payrolls number, they basically were thrown a bone in that wage growth has slowed. So again, who would have thought that saying, oh, people are not making as much money or the amount that they're making in percentage terms is coming down a little bit. But that was the first sign that maybe there's some weakening in the labor market, and the market's just ripped higher on that. Now, I will say this is that ultimately the market is going to like weak data, until we get to a point where we see a recession. And then when the Fed does not come to the rescue, the markets will freak out. And that's my base case for this year. I think by the second to third quarter, we see ourselves in a recession. The market and investors will say, hey, Federal Reserve, we're in a recession. Can you start cutting rates? The Fed is going to say, nope, we can't do it yet because inflation is too high. We don't want to see a repeat of the 1970s where they cut rates too early and then inflation surged back.
So based on what you've just said, that I'm guessing that you are still maintaining a somewhat cautious, if not outright bearish stance in the markets, because basically if the Federal Reserve remains restrictive, we're not going to get a reprieve from tightening monetary policy, right?
No. Yeah, there's no reprieve for at least this year. The only way we get a reprieve is, number one, if inflation miraculously goes back below 2% and then the economy weakens, or if the economy weakens so dramatically that we see like 10% unemployment, then I think the Fed might be forced into stimulating things at that point. But right now, the Fed, yep.
What if they don't raise rates anymore? I mean, restrictive could just mean they can keep rates at an elevated level without bringing it down. What if they don't raise rates anymore and just they don't touch it? Would that still be bearish?
Well, you're going to get the short-term relief rally, right? So right now the markets are pricing in at least a 25 basis point rate hike coming up, maybe at least a couple more this year. I don't think there's much to go, maybe a little bit above 5% on the Fed funds rate. But the bottom line is at the point where they say, hey, we are done raising, we're going to go into a pause mode, the markets will see a very short-term pop. But again, it's going to be short term because as economic data starts to get weaker and weaker, and it is, I mean, you can see, again, more layoffs every single day. Amazon just announced that they were going to lay off even more people. So it is coming. The wave of a recession is on the horizon, and it is going to smoke the US here. And when we get into that point, the Fed is not going to be cutting rates right away, and the market is going to throw a big fit. We are coming into some resistance on gold, so you might get a little bit of a pullback. You can see that this choppy consolidation level, that's where we are. So look for a near-term pullback of sorts, but I do think that gold is going to head sharply higher. I'm going to show you this parallel channel. It's one of my favorite parallel channels here. And again, basically what we can do here is stretch this down. This is what we would call a bullish consolidation multi-year period on gold. And what this tells us is that at some point we are going to blast through the upper end of this and we are going to be off to the races, a la 1975 to 1978. If you go back then, the same exact pattern played out. You had 2 years up here, just like we did in 2018 to 2020. You had 2+ years of choppy sideways action. And then gold literally went from about $100 an ounce back then to $1,000 or $900 an ounce. And again, I'm not calling for a 9 or 10x on gold here. I think I'd be very happy with a 2 to 3 times X on gold. So, for me, this is the play right now. I think next year in 2024, very likely Bitcoin could be the best performer, but gold again is the safest, best bet here for 2023.
Soloway, who has previously stated that stocks are in a bear market and will remain so for at least 10 to 15 years, nevertheless suggested that there are opportunities to make money in bear markets. There are places to go in 2023, he said. There is gold. Gold is a great performing asset. He also mentioned that gold is the best thing for 2023 irrespective of the fact that Bitcoin will outperform it next year, but it is safer and better to hold gold. He also suggested that bear markets provide ample opportunities for swing traders. Long-term investors have had their field day since the Fed began bailing the markets out, he said. It is now becoming more of a trader's market where you buy, but then you can't just tuck it away for 20 years. You want to take the profits and run and buy in the next dip. In other news, digital currency group DCG, Barry Silbert's massive crypto consortium, saw two major setbacks for its subsidiaries on Thursday, announcing that embattled crypto lender Genesis would lay off an additional 30% of their staff, while its HQ Wealth Management division would be shutting down altogether. According to the DCG website, HQ is the life and wealth management membership platform for digital asset entrepreneurs and investors. And earlier on Thursday afternoon, DCG's crypto lending platform Genesis Global Trading announced an additional 60 layoffs representing 30% of their remaining staff. This is the second round of employee reductions at Genesis in 6 months after the company cut its workforce by 20% in August. Thank you so much for watching. If you enjoyed the video, please consider giving us a like and subscribe to the channel to be notified with more interesting content about crypto and finance. Stay savvy.